Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. For this latest edition of the Moneymakers Investment Trust podcast, I've taken the opportunity to catch up with Richard Staveley, who is the manager of Rockwood Strategic, a very interesting and so far successful small cap managed investment trust. We spoke at the podcast just over a year ago in January 2024, Richard, and since then I've been looking for ways to find negatives about your performance since then, but I've been struggling to find any. You've performed very well. The shares are close to an all-time high, if not at an all-time high, and you've outperformed every other small cap fund, which is an impressive record. So I guess I have to start by saying you must be pleased with what you've achieved over the last 12 months or so.
Yes, thank you very much, Jonathan, and thank you for having me on Moneymakers. Yeah, it's been another decent 12-month period for the fund, and no doubt we are pleased with the performance, not least because actually, as with the prior year, UK small cap remains quite a difficult part of the market generally. I would say we haven't got hubristic at all. I'm very conscious that a lack of humility is usually the precursor to managers going wrong. So we're not getting carried away. And that's been helped by the fact that not everything has been going right in the portfolio, despite the fact that the fund's done well. So we've had a number of things do extremely well. And in part, they've offset others that haven't, which is always good just to remind us that we're not infallible at all. So really pleased. I think what's also pleasing is that we've managed to maintain the fund at a mild premium to the NAV, and we've continued to get further support. So the kind of maths I think we did talk about a year ago, where we were looking to do, just to remind any people that don't know us, we're looking to buy stocks that double over 3 to 5 years. And if they did over 5, they'll meet our target returns of 15% a year IRRs. We obviously did more than that, and we're looking to continue growing through issuance. And the combination of those two, actually of high performance and more issuance, meant the fund grew 63% in 2024, which I'm very proud about and excited about, but probably not a CAGR rate that can be continued.
Indeed. Well, that would be impressive if you could. I should, of course, disclose at this point that I'm actually a shareholder in your trust. I feel obliged to say that, but obviously I've been satisfied with what you've achieved so far. As you say, shareholders also start to worry when things have gone so well, because you always think something might be about to go wrong. So perhaps we could just start then with one negative thing, which is not about the portfolio, but about the market in which you're operating. The budget last year, if it had been designed to do damage to the small cap sector, in particular UK companies, they couldn't have done a much better job, could they, really?
It was very, very disappointing, particularly because in the run-up to the election, there was quite a lot of warm noises and kind of reassurances to various city groups that the incoming Labour government did understand that the UK public markets are important and need some help. To then have a budget where the AIM reliefs are essentially halved in terms of IHT relates, that capital gains tax goes up, and that no British ISA, which our understanding was that they were supportive of that initiative, was not being put in place, was incredibly disappointing. I think they may be realizing, let's hope, that that was a bit too far. And we've got another budget coming up, and there now continues to be material news flow that they are looking at the ISAs again, and particularly in relation to cash ISAs. And I think it's unlikely, or I perceive it to be pretty stupid, to just do something about cash ISAs without some compensating or redirection towards equity ISAs. So although there hasn't been much leaked as yet, they may leak stuff closer to the point. I think the fact that 300 billion is tied up in cash ISAs making roundabout inflation type returns versus much, much less in UK ISAs is something that could be addressed, and try and redirecting some of that tax break to UK equities would be beneficial both for the market and the country. And of course, UK focused fund managers like myself. So there's no doubt I am biased in that regard. But actually, as a citizen of the country, I do think we're not prodding people more into our own stock market. I think only 10% of the population now in shares, which is materially less than in America. We need a robust and vibrant capital market in UK shares. And the reality is that buying cash, just putting money in cash isn't very helpful for the UK economy. I think one stat always sticks in my mind about why people need to be prodded to do stuff is that the Child Trust Fund initiative set up by Gordon Brown many years ago, where every person got about 150 quid, I think it was, for their child to invest. The earliest point at which they could get it was 18 years later on the 18th birthday. And I think 80% of all money went into cash child trust funds. So you've got a minimum time horizon of 18 years. I mean, that's probably a time horizon that equity exposure would be acceptable over. So we do need to try and push people more. And I'm hoping that they will do that. What is the case is that the UK government is stretched in terms of its fiscal position. And that puts the onus on the bods in the Treasury and also us to try and prod them into ways that they can help without having a kind of big additional tax and a burden. So it seems to me pretty obvious that they should just do the simple thing and redirect the existing ISA allowances into UK shares. It's tax neutral. And just say, if you want a tax break, it needs to be invested in the UK stock market. And not too fast. Some people go, well, you could then be really clever and buy Bailey Gifford, US growth, or British American tobacco shares that aren't reinvested in Britain. But, I believe in the trickle down effect. I think you'd end up with a lot coming into general UK businesses and the UK listing market, which would be positive.
Yeah. Well, I'd be interested to see what they do. Obviously, they're not going to be cutting stamp duty or anything like that because that would cost them too much money. Unfortunately, they really should do that as well. I guess it's kind of ironic, though, isn't it, that at the moment, about the first time for a long time, you're actually getting a real return on a cash house, which is something you haven't seen for a while. And therefore, that may increase people's reluctance to switch unless they're probably to do so. And I guess some people would argue that actually that money goes into cash houses is recycled eventually. But traditionally, it's recycled into lending or something like that rather than into equity.
I think it's the quantum, Jonathan. I think it's the 300 billion relative to the other side of it. And again, I just think about the maths here. There are over 800,000 people max out their ISAs every year. If we just said, look, every ISA to date is sunsetted with all the tax wrapped forever, so don't worry about what you've existing done. But from now on, if you want to have the ISA break, you've got to invest in the UK stock market. That would be 16 billion a year into UK equities and UK listed trusts as well. You could hit that from April, and that would be something that Rachel Reeves could harp on about in 4 years' time as maybe being a cumulative nearly 100 billion of investment into UK stock market. She won't be able to be harping on about the runway at Heathrow in 4 years' time. And it's tax neutral. So I'd urge the government to be bold. I think it could have big impact.
I guess the fundamental problem may be that if you judge it by what happened in the budget, that this government has either ideological objections to this or just doesn't understand how important it is over time.
That is definitely the concern.
So anyway, coming back to your fund, what's been the worst impact of the budget of those various measures you mentioned? It's obviously had some direct operational impact on some of the companies, the national insurance in particular, and the minimum wage, of course, also a factor, I suspect.
Yeah, so operational, you're right. It's basically the Nix effect. A couple of our companies have high employee bases, not least Capita, the fallen angel from the FTSE 100, which we bought for a recovery. They've got tens of thousands of employees and are trying to do a turnaround. And they've got a big cost-saving program going on, but that has taken out a big chunk of the benefits that would have helped the business rebuild its profitability. So that's been a bit irritating. Also the same with James Fisher, which is a marine energy and defense business that's been around for over 100 years in the portfolio. That's also got a lot of employees. So in a number of the holdings, we would be getting better upgrades than we will be getting, or no upgrades, like the company Restore we're invested in, which does document storage and document shredding. They basically came out and said, look, we would have had upgrades, but the Knicks have taken it out. We're going to meet our expectations, but it's a cost we have to take on the chin. I think the second thing is with regards to AIM. So the fund today has 23 holdings in. But National World was a stock we bought early last year and has actually really rapidly received a takeover bid near the end of the year. So that'll drop out in the next few weeks and we'll be back to 22 holdings. Of the 22 holdings, 12 are on the AIM market. And it does feel to me in the last few months that AIM stocks are seeing outflows from various AIM managers. It doesn't feel very well. FTSE small cap index actually worse than AIM so far in year to date, but it's a very narrow index. There's nearly 100 stocks now in the FTSE small cap, so it can be affected by 2 or 3 of the larger holdings. But it feels as if it has put a bit of volume coming out of these stocks just gradually.
I guess one could say that's obviously bad news, particularly in terms of the operational differences that the budget's made, but also this problem with AIM. But if you're being cheery, you would argue this might be creating some more opportunities for you.
No, absolutely. And I should just say, actually, within the budget, the focus on infrastructure is also very positive for 2 or 3 of our holdings. Galliford Try, for instance, which is a construction business mainly focused on infrastructure, water sector, energy transmission, same as Van L is another business that's focused on the infrastructure sector. That all looks pretty positive for them. In terms of pipeline, my hardest thing when I wake up every morning is trying to work out which of the pipeline is the best to execute on, the best risk reward. It is strong and we've completed due diligence, or due diligence is actually something you never complete, but we're sort of majoritively done on a number of holdings, which we're watching quite carefully for the right either liquidity or moment to start actively building them. But there's no doubt that this market is, I think I have used this phrase before, but it is a bit kid in a sweet shop type of stuff. You basically got most of the UK small cap managers that have open-ended funds have got some form or pace of outflows, and broadly UK equities do as well. And broadly, people that are interested in shares are focusing like they always do on where the performance has most recently been rather than where it might be. So they're selling their UK shares so they can tell people down the pub that they own Nvidia. So in the end, that will turn around. I've never claimed that I'm a macro guy or macro market specialist. I think it's a very dangerous game to be playing in, although that's what the media like fund managers to do. We are very, very, Jonathan, as you know, bottom-up stock pickers. But I would say that the key to change this, other than nudging from the government, will be the interest rate cycle. So watching that very carefully will be the catalyst. There was a period in the run up to the budget where interest rates started to fall. The market started to realize they were falling, and UK small cap started to generally perform a bit better. The brakes have been put on that, A, by the budget, and B, let's face it, by inflation data that is not helpful for significant cuts. However, if things continue to get worse in some sort of doom loop for the UK economy generally, then it's quite possible that the inflationary numbers are temporarily higher than our target levels, and the economy moves into either recessionary or very close to recessionary terms, and we get faster interest rate cuts. And I think that would be quite supportive for a stronger period of outperformance from UK small cap if history is to rhyme.
Now, I'm just looking at some of the components of your portfolio, and what's been striking is that even just year to date, I've been looking at some of these names, and there is an extraordinary divergence there, isn't there? I mean, some have done very, very well, and we'll talk about those, and some have done surprisingly poorly. So some of them down 15% or something year to date, others up more. Let's talk about the good one, shall we, first of all? Let's talk about this phenomenon that is Filtronic, which is a company that's been around for a long, long time and has suddenly gone into orbit, shall we say.
It really has. Yeah. So for those that don't know it, it's been around for over 20 years. I followed it for over 20 years. It's based bizarrely in Tony Blair's constituency, where for some unknown reason, a fantastic business park sprung up in the countryside near Durham and Sedgefield many years ago. And Filtronic are based on that business park, mainly because the kind of core intellectual capabilities to do with radio frequency technology used in defense markets, in telecommunications markets, and now the space market. And Durham University has a real specialism in that historically. The business was pottering along, had got itself in a real mess during the TMT bubble, because in the first wave of networks that went out, they were using radio frequency masts predominantly, and Filtronic went through a huge boom in demand. And then the then management team got carried away and bought a semiconductor fabrication plant, which really did cause them a lot of problems. Anyway, that's all flushed out. And what's happened is you've now got quite a niche business. They still do product alongside Nokia into 5G, where 5G uses masts. So in India, in the Indian rollout, which has been a bit slow, they're focused there. In defense, one of their very first customers was the Tornado radar, and they're in the upgrade of program for that, I understand, at the moment. So they have these solid positions in defense, but what's transformed the business has been a brand new market. I mean, it's just fantastic to see, which is space, as you touch on. And it's the low Earth orbiting market, which obviously Elon Musk is the world leader in through his Starlink network. He is the first of what will be a number of low Earth orbiting networks. There are others. So the OneWeb one that Britain's involved with is also another. Jeff Bezos has got one he wants to put up called Kuiper, using his rockets. And there's a range of other people. And essentially, it's because the cost of getting things into space has come down because of Mr. Musk's fantastic re-entry rockets. As a result, Filtronic, we bought it when it was about 25 million market cap. I think I first started buying it at 12.5p. We're now today at £1.06. And I'm pretty sure it's going to end up being a 10-bagger, which would be fantastic for Rockwood to have its first 10-bagger. But the business has developed a product which no one else has to solve the problem in various wavelength bands for Mr. Musk, so that he can fire all the data up as increasing data goes into his network. It requires different bands, and so you can have low latency, not slow internet speeds for all this data and the important users that are using these networks. They are working on 2 other wavelengths now. So even though the shares have done extremely well, the 2 of the wavelengths, they haven't announced what they are. We can guess what they might be, but they could be as much business as what is existingly done from what's called the E-band, which is what they've won their first business from already. And that business is also continuing to grow. Now, at the moment, Filtronic have only announced they're in the ground stations, beaming up and amplifying the signals up to the satellites. They're also trying to develop products to go into the actual satellites, of which there are thousands and thousands. So the scope for further growth at Filtronic is pretty material. Now, I do remember, because obviously I listened to it before we chatted, Jonathan, our last chat, and we talked a lot about bids in UK small cap, and we'd had a number of bids in Rockwood that helped our performance. I know I've just mentioned National World, but that was the only one last year. We only had one bid last year. What's interesting about both Filtronic and also another key driver of performance last year, Funding Circle, is that we have been able to reduce our position. They're still weighty holdings, but in both of those holdings, we've realized profits to the tune of slightly more than our original investments. So we've taken out all of what we originally put in and still have material positions in the holdings. But the important point there is we've done that into the secondary market, into quite a difficult market with fund managers with outflows, thus proving that there is liquidity there if things go well.
So people will say maybe Filtronic, on past trends, if it's successful and goes on being successful, will be snapped up by somebody, because it's still quite small, right?
Well, there's 2 things here. Firstly, if you're solving problems that no one else can solve, that gives you a lot of strategic value. Mr. Musk did get involved in Filtronic, excitingly, since we purchased. So we started, I think, 12.5p. SpaceX have taken warrants as part of the deal they've done with them to give them lots of business at 35p. They've obviously made a return on that well, but it means SpaceX have a minority position if they exercise warrants of 10 to 15%. But we could think of lots of people that might want to own Filtronic. The key is really understanding how big this space market could be, because it's quite exciting from a British perspective. I mean, it could become a really quite exciting, decent sized technology business. And I know the large cap managers in the UK are sort of crying out for these things because everyone keeps moaning that it's sort of oils and banks all the way with the UK stock market. But Filtronic has got high margins, high growth rate, unique IP, selling globally. It's becoming a British success story. Just to put it in context, with market cap now is nearly at our limit for anything we'd initially buy in the fund. So it's now nearly 250 million market cap, but one could see this be quite a lot bigger if they continue to grow their sales.
So you say it's an initial position, has to be less than 250, but how long can you go on holding it once it goes past 250 million?
There's no rule with it, Jonathan. Running winners is one of the key things in investment. It's always been something where I haven't done, I've regretted later. We definitely have a winner. But you have to, alongside that, have key views on the intrinsic value or the amount of upside. The amount of upside right now with the contracts not yet announced has narrowed from when we first instanced, i.e. there isn't 100% upside in Filtronic from what we know now. We could speculate and guess what kind of growth, but it isn't 100%. But we expect during this year and over the next 12 to 15 months there to be news flow which could materially change the amount of upside. So the point is, we're going to run the winner. The reasons why you sell a share are, when they start disappointing, your thesis is broken, they take on too much debt, dodgy M&A, or there isn't sufficient upside. But valuation itself, using that as the sell discipline, has historically been quite a dangerous thing for investors. So although the valuation is definitely higher than when we purchased, I think on a PE basis now, even what we know, it's on about 20 times. And the market expectations for Filtronic are actually that it falls in size in 26 relative to 2025, which could prove to be deeply conservative based on anything they win in the next 12 months.
Do they have to fund this expansion that they're talking about?
Great thing is, no, they've got net cash and they're generating a lot of net cash. And what's fantastic is they have a very high drop through because it's essentially a manufacturer of the components. So the drop through profitability is significant as well. So the only way they would possibly even mildly need to have some extra money would be to fund working capital for mega orders. And I'm sure actually something like that could be worked out with the people replacing the orders, because really it's unfair to give Filtronic the balance sheet issue of dealing with that. So we don't think they're going to raise money. We think that it's going to keep on delivering.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. Well, just take the other extreme then. We'll look at Funding Circle. That's your largest holding, or was anyway. And that had a good year last year, as you just mentioned, but the shares are down around 70% this year, according to my data source. So what's going on there? Is that a sign of times ahead?
Yeah, just the most recent information first, and then what's happened since. They had a slightly irritating press article stroke court case, which they're not in, where they used to have more loans than they do now. And they obviously have built this big platform to facilitate lending to SMEs. They sold off some of the loans that they used to have, which they've done many times, to specialist people that want the difficult loans that clients have taken. And one of the lendees, very the small businesses, has hired a firm called, you can't make it up, David and Goliath. And David and Goliath has brought a case saying that the people who gave personal guarantees about the loan don't have to pay it. Now, Funding Circle don't own the loan anymore, but they made this comment that the paperwork wasn't good enough, and as a result, they don't have to pay. And the shares got a bit knocked on it. I can't tell you how relaxed the management team are about this. They think their position is extremely strong. They think this is a flight, but it's not been a helpful piece of news flow that came out. I think the second thing is they did come out with a trading statement saying trading was in line. I think it's possible some people were hoping for a modest upgrade. We might still get that when the actual results come out in terms of forecasts for the next couple of years. But I think the lack of that, and in the start of the year, there may have been a few people just taking a few profits to do other things after a good year in Funding Circle. From our perspective, it's been a brilliant case study for those, again, that don't know Rockwood about what we do. So when we bought this just over a year ago, we identified that Funding Circle, again, was down to a market cap of 125 million, Jonathan. It had floated at 1.5 billion quid by Goldman Sachs in 2018. And by the time we're looking at it, Rockwood, everyone hates it. No one's happy. Everyone's upset. 125 million. And you could buy it with results stating very clearly that they had 230 million pounds of net cash on the balance sheet and were getting close to profitability. What we then did was our usual Rockwood stuff. So we started talking to the advisors, to the board. We had meetings with board members, the management team, but also other stakeholders, so other shareholders, and asked them, what their engagement had been with, what they were upset about. And it became very clear that the board had been very slow to adopt buybacks, which the company could clearly afford given its balance sheet and the deeply discount to intrinsic value that the business was on. So it'd be very accretive to shareholders. So we started buying the shares. We got up to about 3%. Normally you have to get up to 5% before people take you properly seriously, because that's the level you can call an EGM at. And we're happy to do that at Harwood, and we have done that regularly. But we got up to 3, but it was a very positive and constructive way that we engaged with everyone. And essentially the penny dropped and they started announcing these buybacks. They also did their very first proper cost cutting, which they hadn't done since IPO, which is, again, it was a growth company. It's quite a difficult mindset for the guys to get their heads around, but they did. They've taken 15 million quid out of the cost base. And as a result, in second half of last year, hit profits for the very first time. So now we've got this absolutely fantastic technology platform facilitating loans to small businesses in Britain, still with loads of net cash. Arguably, we would say still with a bit too much cash. So we think the buybacks will continue, and significant share price performance. And I think the pullback, again, I'm sort of relaxed about that completely. The buyback continues. Again, as I mentioned, we have actually taken some profits in this, but we still see material upside. The company is targeting a compound annual growth rate in the top line of 15%, and I think 15 to 20% margins. So they've only just hit profitability. So there's quite a big margin improvement story, narrative, and delivery for these guys to do, which will bring a new type of shareholder back to the stock as they deliver that over the next couple of years.
And one of the comments I've heard about Rockwood is that you are very impressive in terms of how much you disclose information and so on about what you're doing, explaining the rationale and the history. But you don't always tell shareholders directly when other vehicles in the Harwood stable are also shareholders in this thing. Is that something that you might do? That's question one. Obviously, people can find that information out for themselves by doing their own homework, but you don't disclose it. Question two, which you mentioned buybacks and so on. We know that Harwood Capital just launched this investment trust, Achilles, which is going to be doing positive activism, if you like, in the investment trust space. Is there anything that would actually preclude you from investing in an investment trust?
Yeah. So second first. So when we moved the fund from AIM to the main market 2.5 years ago, we actually put in the articles that we can't invest in other investment trusts. So that won't happen at Rockwood. We'll only buy stocks. So that's clear. That said, I'm sure Christopher is going to have quite a lot of fun with Achilles whilst he's making everyone lots of money with Mr. Naylor. So that fund was launched because people asked them to do it, which they probably haven't said publicly yet, but people said, why don't you do this? We like what was happening. So we'll see how he does. There is quite a lot of discounts out there in a variety of alternative asset classes, some of which may have listed in a period where the story fell on easier ears when there was no interest rate around. So we'll see what happens next there. Now, to come to the Rockwood and where Harwood buys holdings, the reason we don't do it explicitly is just because of the legals. Rockwood has its own board, its own shareholders. Harwood has the contract to run it, which I execute and manage, but there isn't an investment team per se. I'm not on the team for North Atlantic or on the team for Oryx International Growth or indeed Odyssean, which is a completely separate LP. So from day one, I've been a bit nervous about sort of putting in data about what other people's funds are doing, even if they're very close. However, in every single meeting that I have, I'm very happy to explain to everyone exactly what other Harwood funds are involved with. We just don't put it on the slide. I just prefer talking about it rather than having it written down. The order is both ways. So Christopher has bought stuff and then I've bought stuff and then the other way around as well. At the moment of the 22 holdings, there are 5 holdings that are owned by Christopher and Nick Mills in those funds. And there are just 2 that overlap with Odyssean, one of which is the same one, which is a company called Flowtech Fluid Power. It was pretty helpful, I have to say, when the fund was much smaller, to have Harwood alongside, not only believing in the same thesis that the shares were very undervalued, but allowing that firepower to make sure we had influence, we can actually catalyze unlocking that value. As the fund gets bigger, that's probably slightly less needed. Although the fund still, we shouldn't get carried away, Jonathan, it's still a £100 million fund, and that's still relatively small in the world of investment trusts. But just so that anyone who's really focused on this wants to know, Centaur Media, Rockwood owns and is 29.9% owned by Harwood. ADF, Rockwood owns, we have about 4%, and Harwood has another 9%. Flowtech Fluid Power, owned by Odyssean and Christopher and Rockwood, we are at 29.5%. James Fisher, which is owned by Odyssean and Rockwood, we're just over 10%. I'm very excited about the outlook for that stock in 2025. That's just one of the ones I think is going to really deliver value for us. Restore, I bought that. Christopher then bought it afterwards, really likes it. We're up to nearly 11-12% of that company. And TriFast, it was the same, and we're up to about 15% of that. And Nick Mills is on the board of TriFast. That's it. Those are the ones.
Okay, so obviously it's of interest because both for the quantum of it, but also the extent to which you, in one case, might be on the coattails of them, or the other way around, as you say, who initiated it in the first place.
Yeah. Speaking completely transparently about it, I'll make mistakes, so will Christopher. So we're good skeptics on each other's ideas. And that's sort of the basis. Secondly, I think that I don't want to have too much overlap with the other funds, because it's not helpful for you or shareholders or anyone else thinking, oh, they're all sort of the same thing to greater or lesser extent. So I think just trying to pick a small number of his very best ideas, or ones that suit Rockwood's style within his funds, is good, because he has a fantastic track record, as does Stuart. But there's a lot of other ideas. So it's probably at the max now, to be honest. I can't see it being much more than 5 or 6.
Okay, so because you've done so well, I feel happy to raise one issue with you, which when we spoke a year ago, you said that it was very unlikely that things you invested in would go to zero. And there has been one that's gone to zero, and that was called Hostmore. The fact that it's changed its name might have been a bit of a warning sign, but what happened there? I have to put that to you.
Yeah, no, that's completely fair game and very, very upsetting for us. So I still stand by my comments from the last time, which is that we do significantly more due diligence. So we typically miss out on things that go to zero, and that value investing has a bigger margin of safety than growth investing. And that we are predisposed to have businesses on the whole that have limited leverage or a route to deleveraging quickly, either through disposals or better free cash flow generation, all of which are the reasons why you don't end up with zero. Zero being because the balance sheet's taken over from equity in terms of too much debt. I think with regards to Hostmore, the only crumb of comfort for investors are that because we lost 100% for those in it, was that it was a small position. It was consummate to the risk. So it was just over 2% of NAV, rather than a core, much bigger position. I'm not just saying that with the benefit of hindsight. It was taken at the time that this is a high risk reward setup. I've said to investors before, and will consistently say, the whole concept of parallel universes that some investors talk about, that some of the greats talk about what didn't happen but could have happened, but you only think about the reality that did happen. We're absolutely sure that the thesis regarding Hostmore meant that there was at least 400 to 500% upside if they've been able to trade through. It owned the TGI Fridays brand in the UK. And at the end of the day, the trading environment was just too much for them during 2024. They'd pulled every lever to improve profitability and reduce cash. And then they're eating out, particularly in the run up to the election, and also with all the labor cost pressures that they continue to have. They couldn't pull the levers that other restaurant businesses are able to do. So quite a lot of restaurants were doing 2-for-1 offers, but they just weren't able to do 2-for-1 offers because they wouldn't generate any cash. They had to pay the debt down, so they had to take it on the chin. They tried very, very hard. And you cover Sherburn, the Sherburn investors, the Bramson vehicle. I think it still exists listed in London, but the Sherburn guys were involved with trying to do the turnaround on the team. Their involvement was because it was the last investment in the Electra Investment Trust. And they did everything we can to try and turn it around. But in the end, the debt overswamped it. To put it in context, they should have been able to do 10, 15 million of free cash flow in a normal year at least. And the market cap when we were buying it was only about 25 million, and the debt was about 30. So if we just traded through for about 18 months, 2 years, the debt would have been under control and they'd been all right. But in the end, there just wasn't enough time left for them. I think it reiterated in my mind that position sizing remains a very, very important thing for this strategy. And I would highlight something I didn't say a year ago. I'm pretty sure of that, talking about this concept of losing money, is the holdings that become big in the fund will be ones which have become big because the thesis has gone right and they've done really well. And that's the point, this running the winners point. At that point, everything you've expected, or nearly everything, is sort of going what you thought would happen. So the risk profile actually is massively reduced because your thesis is essentially correct. Where you get in danger is if you have this kind of strategy, and to be fair, it was slightly used prior to me becoming manager at 19, where you initially go in with a massive holding on something where you think you've done all the due diligence. And I think we're just remain quite gradualist about how we have these two holdings. So the big holdings would normally be 5 to 7%, maybe 10. I haven't had one yet in 5 years, straight off the bat. The smaller positions are 2 to 4% of NAV. And more often than not, they're going to be those to start off with and then become 5 to 10ers. If you take a funding circle, for instance, where we've tripled our money, it is actually, I can update investors now, because of the profits we've taken, that's now down to 5% of the portfolio, had got up to 14% of the portfolio. Filtronic had got up to the same 14, actually taken less profit in that. That's about 9.5% of the portfolio now. But also, unlike many fund managers, this running the winners crest check, which drove a lot of returns, and Augean before that, we did allow to run into 20% plus, and that really benefited shareholders. Both were on the receipts of takeover offers in the end, which is what we expected would happen.
So to finish off, Richard, obviously lots of things we could have talked about, but I did concentrate on the outlook from here. Obviously, you mentioned the fact that there's only one M&A deal last year. You had 5 the year before. Is that the key to what happens this year in terms of you've got your portfolio at the moment, you're still issuing shares, which is good. That gives you a bit more firepower. How do you see this year panning out then? Are you hoping for more M&A to actually raise more cash and generate some realized returns? Or are you happy just to see these things play out, work their way through their current issues? What are your hopes for the coming?
I think a small number of the portfolio, and we don't have many, 22 holdings, as I said, there is a small number in the portfolio that I wouldn't be surprised at all if they were on the receipt of takeover offers during 2025. A number of others will be eventually, but that's unlikely to happen in 2025 because they're not at the point yet where it would make sense for shareholders to accept a bid, and the premium would have to be very, very significant, like 80, 90% above the current share price to make sense for investors. I'm thinking things like a Flowtech Fluid Power, which is 65p. That company could easily double, triple over the next 3 years. It's got a completely new management team. Balance sheet's fine. The management team have been sorting it out over the last nearly 2 years. Process, footprint, cost savings, approach to business, branding, website, the whole thing's been changed. That's a business that we have about 3% of the portfolio in, but could easily be 2 to 3x, but could easily be subject to a bid because it's in the distribution industry, which is consolidating both by trade and by private equity, but it could end up being on the receipt of a bid. So the corporate actions rather than M&A is something that will feature. So the largest holding, which is RM Group, I've been waiting very patiently, like a proper value investor, which I am, for them to start the breakup of that business and the very first disposal, which will pay down the debt at RM. I'm expecting that to be a catalyst for the shares during 2025. At Restore, where we've continued to add to that business, where Charles Skinner has been turning around, I wouldn't be surprised if they decided to look at how ridiculous the share price is. It's on AIM. It's very cash generative. They could easily announce buybacks, nothing yet announced, but that would probably catalyze the shares there. Filtronic would be more about contract wins. And then a number of the companies will be about basically operational delivery, which will just be because of the results. So if you take a James Fisher that I mentioned earlier, or a TriFast, these are businesses where all the hard work's been done and the margins are still at a big discount to where we think they can get to. Literally, all those names, they should be at least double the current level of operating margin. And we think they're just getting these stocks, just getting into the delivery phase. So there's quite a lot of pent-up profit improvement that has been sort of building up because of all the actions these guys take that takes time. And we should start to see that being delivered transparently to the market now during 2025. And I think that will act as catalyst. If stocks like James Fisher start to get into an upgrade cycle, those shares are going to really move because, just to put it in context, the market cap is 160 170, maybe 180 million. They've paid off significant chunks of the debt. So the EV's only about 250 or something like that, maybe 240. But that business could easily do 80 million of EBITDA in the next 2 to 3 years. So it's literally on, it's a 4 times a recovered EBITDA. And that company traded on 10 times EBITDA for many years, but it's been derated because of all the problems that it had. And that just be same with a Flowtech, same with a Trifast. Trifast has over 200 million pounds of sales, but it's making a 5% margin. We think it can make a 10% margin. We've now put an LTIP in place where the CEO will get lots of money if he delivers on a 10% margin and the shares respond appropriately to that. And that, again, should double the share price as he delivers on that improving margin. But these things not straight lines. So 25, it'll be 5.5. Now it should be 6.5, and gradually it improves.
So that was Richard Staveley, the manager of Rockwood Strategic Investment Trust, a specialist UK smaller companies trust, talking to me earlier this week.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.